Hello everyone, welcome back to Trading Club 7U. Today we're going to dive into one of the most critical aspects of trading, and that's risk management. Now, I know some of you might be thinking, wait, isn't prediction what trading is all about? Well, let me ask you, have you ever made a prediction about a stock or a currency pair, only to have it turn out wrong? The truth is, we can't predict the future with any certainty. Markets are inherently unpredictable, and even the best traders can't always get it right. But that's where risk management comes in. Risk management is the process of minimizing potential losses and maximizing potential gains. It's the difference between being a smart trader and a reckless one. So, let's say you've made a prediction about a stock, and you're convinced it's going to go up. You buy a certain amount of shares, hoping to sell them later for a profit. But what if the stock doesn't move in your favor? What if it goes down instead of up? That's when risk management comes in. By setting stop loss orders, you can limit your potential losses to a certain amount, making sure you don't lose too much money on a single trade. For example, let's say you buy 100 shares of a stock at 50, and you're planning to sell them at 55 for a profit of 500. But what if the stock suddenly drops to 40 due to bad news? If you have a stop loss order set at 45, you'll automatically sell your shares and limit your losses to 500. That way, you can avoid losing even more money if the stock continues to drop. But here's the thing, if you'd set a stop loss order at 47, you would have limited your potential losses to 3, which is 497 less than buying and selling at 50. Setting the right stop loss order at the right price can save you thousands of dollars in trades. Now, I know some beginners might think, but if I don't take risks, I won't make any money. That's true, risk is a necessary part of trading. However, the key is to take calculated risks, not reckless ones. Reckless risks can lead to significant losses, and even wipe out your entire trading account in extreme cases. Over-leveraging is a common mistake beginners make, or using too much borrowed capital to trade. This can amplify losses quickly, leading to a situation where you can't afford to cover your losses. Another mistake is not setting stop loss orders, or relying too heavily on predictions rather than risk management. For example, let's say you have 1,000 in your trading account, and you borrow another 5,000 from your broker to trade. This is 5x leverage. Now, if the stock you're trading goes down by 10, you'll lose 3,000 of your borrowed capital, and also 3,000 of your own capital, because of the margin call. If the stock goes down by another 10, you'll lose another 3,000, and you'll be left with 1,500 of your own money. If it goes down by another 5, you'll lose the rest of your capital. This is why over-leveraging is a serious risk, and should be avoided. Another common mistake is not having a risk-reward ratio. A risk-reward ratio is the relationship between the potential loss you're taking and the potential profit you're targeting. For example, if you're planning to sell a stock at 55 for a profit of 5, your risk-reward ratio is 11. This is not ideal, as it means that for every dollar you might lose, you're also risking a dollar you might gain. It's better to target a higher profit and a lower potential loss, such as selling a stock at 62 for a profit of 12 with a stop loss order at 57. In this case, your risk-reward ratio is 23, meaning that for every dollar you risk, you might gain $2. For your homework, I want you to practice setting stop-loss orders on a demo chart or in a paper trading journal. Choose a random stock or currency pair and set a buy and sell price. Then set a stop-loss order at 10 below your entry price. See how much you can limit your potential losses. Practice this exercise several times, and you'll get a feel for how risk management can help you trade more safely. Also, I want you to practice setting a risk-reward ratio in your trades. Choose a stock or currency pair and target a profit of 10 for every dollar you risk. For example, If you're planning to buy a stock at 50, set a take profit order at 60. Then set a stop loss order at 10 below your entry price, at 45. This way, for every dollar you risk, you